Hello, this is John Smallwood, Senior Wealth Advisor at Smallwood Wealth Management, located in Red Bank, New Jersey. Today, we are continuing on the conversation of the 19 sources of retirement income. What's in your retirement plan? How many sources of income do you have? Will your plan be durable enough? Will it have enough flexibility to benefit from the changing aspects? Are you aware of what exists? What do you know out there? Okay. Today, I'm going to talk about something that most people would like to know more about, and it's having Roth income. Roth income is extremely powerful because the income from a Roth IRA is tax-free in retirement. Where if I have an IRA, that income is taxed at whatever the rate is at that time. So let's start with the basics, and then we'll walk a little bit faster and we'll get going. So the idea is that if I put money in an IRA, that IRA is pre-tax, which means it grows without taxation. But when I take it out, I'm going to pay tax at the current rate that I'm at that point in time. You may be right now with the tax laws the way they are, you may be in the lowest tax bracket that you've ever been in your entire life. And deferring, or you might be new and you're starting to accumulate money, and you're putting money into an IRA, it was at a low tax bracket, you're deferring it to a future where it's going to be in a higher tax bracket. That may not be good. Or you may be a couple of years from retirement, and putting money into an IRA or 401k makes sense because I will be in a lower tax bracket because I haven't accumulated enough money for retirement. Not something that I really want to talk about, but that happens, okay? Then there's money that I can put into a Roth, which is after-tax money, grows without taxation, and is tax-free. Now, there's also a 401 Roth. Most people don't know that the 401 Roth exists, and there are no caps on the income. So you can make $1 million a year, and you can put in the $19,000 into a plan on a pre-tax basis in your 401 Roth. If you do not have a 401 Roth and you want to make a Roth IRA contribution, and you're married filing joint, once you cross over $200,000 of modified adjusted gross income, you're no longer eligible to do a Roth. You can do a Roth conversion of an IRA, but you got to pay the tax now. Whole conversation that we want to talk about in a different light, whether that makes sense to pay the tax now. We all think tax rates are going up, but they haven't, right? So we don't know that's true or false yet, right? But here's the power. If I have money in a Roth account, when I hit retirement, that is not a taxable income source. That is extremely powerful. The new Secure Act that came out recently is changing some of the impacts on a Roth plan. One of the more powerful things in estate planning and wealth preservation and passing it on is there's no required minimum distribution on a Roth. So therefore, I could let that Roth compound from the age of 50 to the age of 100 plus, and I don't have to take any money out of that Roth. When I pass, there's a beneficiary or decedent IRA and a decedent Roth IRA. The IRA is subject to a required minimum distribution based on the beneficiary's life expectancy. And the Roth also had to take money out even though it wasn't taxable. You could not continue to defer the whole thing. The new Secure Act has collapsed that deferral period from lifetime to 10 years. So now, inheriting a Roth, you have to take the money out of the Roth over a 10-year period. It will be tax-free to you, but you still have to take it out, which is a new change in what's happening. But I think what's really important is people put money into 401ks and IRAs without thinking about the exit strategies. And well, I'm in a high tax bracket, so I'm going to put all my money in the 401k. You should really look at and run simulations and see based upon your current saving rate, what tax bracket do you think you're going to be in? Will you stay in the same general area because you're doing a great job of savings, or will you end up in a lower tax bracket? The sole purpose of tax deferrals is to defer from a high bracket to a low bracket. If that's the case, you win. If you go from a low bracket to a high bracket, you didn't benefit at all. In the Roth, now you pay your taxes and you grow without tax and you get the tax-free income. It might be a really beneficial way to have a portion of your money, because it doesn't. What's also interesting is in the 401k and IRAs and profit sharing plans, once you hit 70.5 or now 72 under the new Secure Act, you have to take this required minimum distribution, where the Roth does not have a required minimum distribution because they're not going to get the tax from it. So you want to look at having the Roth income so that when you're receiving income, it's not throwing you into potentially a higher tax bracket. It might keep you under one of the tax brackets. It's a very beneficial tool, something that you should consider doing potentially a Roth conversion, looking at, doing some of it depending upon your circumstances. One of the things that I want to do is I want to start thinking about, and this is about strategic strategies, as we start talking about different strategies in these 19 sources of retirement income, there are tax losses and things that you can generate in charitable contributions that might allow you to do a Roth conversion or an IRA to Roth conversion without paying any tax. That's about strategy. It's not about a product. It's about combining multiple ideas together to get an outcome, a better outcome. So the Roth income can be very powerful. To find out how to get more Roth income, we should have a conversation. You can take advantage of what we call a wealth curve pressure identifier conversation, which allows us to help you. One of our advisors gets to help you, talk to you, and understand what's going on in your plan, identify where you are now, how close are you to having all of these 19 sources of retirement income, what steps can you take today, and all that pressure you have between now and retirement. If you're 40, 50, 60, you've got colleges and weddings and mortgages and business things and all kinds of great pressure. But the key is, how do you navigate through it and get the outcome that you're searching for? So take advantage of the call, request a copy of our 5 Raise Your Wealth Under Attack book, download a copy of the 19 Sources of Retirement Income, go to smallwoodassociates.com, take advantage of those offers. And if you have an idea for the podcast, let us know. Share the podcast with friends and family and coworkers and enemies, etc. Anybody you think could benefit from the conversation. Appreciate it. Have a wonderful day. Thank you.
Welcome to the end of the video. Smallwood Wealth Management is an investment advisor representative. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented for this educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as a receipt of or substitute for personalized advice from Smallwood Wealth Management or from any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or an accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you for listening.